Hello, everybody. Brian here from quantlabs.net for December 1st. I haven't done this in a while, and I don't do them as frequent as I like because I'm focusing on strategy development. Anyway, so I thought I'd spend a couple of hours going through the Bloomberg News app consumption as I try to do. I haven't done it since Sunday. Anyways, the one that really came back was this about Canada. Canada having added 70 or 79,000 and a half jobs from in November from October, which sounds quite a bit, but there is danger lurking in the water. So, with a mental disease in some of the Canadian politicians and the sheeple that buy into it are destined for a big scare. Here's why. Now, this is from Staffing Industry Analysts. I have no idea who this is. This is from through Google, but these are interesting stats. Statistics Canada in real gross domestic slowed to 0.4% in the third quarter of 2017, following a 1% increase in second quarter. However, when expressed in annualized real GDP, rose 1.7% in the third quarter. In comparison, real GDP on the annualized growth of 3.3%. I could continue on about it, but here's what needs to be identified. When you look at what is happening in a lot of the big countries, central banks find that a tool to curb bubble is doing the job. This chart on Bloomberg here, three economies battle household debt that outpace GDP, gross domestic product. Others close. Here's the joke of the whole thing. Switzerland, Austria, Canada have problems with household debt where it's outpacing the GDP of that country. So what's happening is, from a chart that I put up, over 2/3 of that GDP was driven by consumption debt. That is very dangerous because here I live in Toronto, and the cost of living here is so outrageous compared to people with jobs, let alone the crazy liberal morons that run the show. And I blame the people that put them in there. Is let's tax, but yet people are having problems to keep ahead with inflation at a crazy place like Toronto for the inflation, where people cannot afford mortgages for $1 million houses on average. Plus, there has been literally no increase in wage inflation over the last 20 years, which has been very, very, very tiny compared to carrying a mortgage for a home. So these three countries are identified as having real problems for their local citizens to keep up, where the, as it says, consumer household debt is driving GDP, which is like danger, red alert, don't go there. And we've got Switzerland number one, 120% of GDP. Australia, around not far behind that, as well as Canada, North Korea, UK, US. And I think US has dropped off because of the recession. Then China and Italy. Okay, so where does that leave us? So here on the household debt, financial consumption, expenditure according to the World Bank, and again, the numbers never lie. You look at Canada, it's pretty crazy. Now, so for Canada, 58.3%, again, let me read this, household final consumption expenditure percentage of GDP. So what does that mean? And remember, this is lagging, where Canada is 58.3. Now, again, I do a lot of global news, and when you look at this chart here, it goes way back to 1965, where that figure has not been reached since 1965, and it's been steadily climbing. So this is not a good sign for the Canadian economy, because it will have to eventually pop. Now, the other country that's ahead of Canada is South Korea. Now, if there's a way I can um, sort this, I would. So let me see here. There is no South Korea. Maybe it's under Korea. I don't know. Uh, Korea, I imagine it's Korea Republic, 48.8%. So let's check out Switzerland. Well, let's see. So U.S. Hasn't reported it, I guess. Let's see what the top says here. 1960. So for some reason, the U.S. has not reported it. I'll just take a look at the chart here for comparative reasons. So I guess it's still fairly high here at 68% of, again, household final consumption expenditure percent of debt. So if we look at Switzerland, we don't have any data at all. So now this is kind of weird because it's not as high. Let me go back to the debt here of this chart. So this is now Bank for International Settlements on this Bloomberg chart. And that's for Q1 of 2017. So this is where I get confused, like which chart, which source do you rely on? And you want my honest opinion, I'd rather take this one found at Bloomberg. So we'll throw out this business of the this World Bank. I don't know. So there's that. Now let's talk about Europe as a joke as well. These are the statistics of the European Central Bank. This is why things do not look pretty for Europe and pretty well globally. When you look at, this is the interest rate of paid out on deposits, key interest rates for the Euro area. Now I guess this is the aggregate of the Euro and Euro members. So let's go far back to glory days of, dare I say, 1990, 2%. 3.75% 2000 and 2000, and it steadily dropped month by month, or I guess quarter by quarter, from 3.75 down to 1% in 2003. You wonder what went on, but that's okay. It did come back in 2008 for July. I guess that's during the financial crisis. Stayed around 3%. And then guess what? 2009 rolls around, down to 1%, and it just dwindles by the end of the year at 2009, 0.25. And I guess that's where they're trying to stimulate the economy by raising it a little tiny bit to a huge 0.75, and it drops back down to 0.25. And then the inevitable, that's never supposed to happen, where the lunatics take over, and it drops at 2013 November, and now it drops below. Guess what? Deposit facility drops to negative 0.1, and here we are, March 2016, negative 0.4. Now I find it quite odd, where why oh why did this suddenly stop? So let's see. Is this again? Once again, if you followed my Federal Reserve analysis I put out a few days ago, maybe this is another way. Oh, we're in danger and we want to make ourselves look good. Therefore, we shall reset this data under some other data set to make themselves look better as they move forward. At the end of the day, when you're this is not supposed to happen, of negative deposit facility interest rates, because this is the central bank. You have other banks in each member of the Eurozone that's dependent upon this, and now all of a sudden a lot of other countries are paying out negative rates to their citizens. So namely in the big ones like Germany, Spain, Italy, Portugal, wherever else, France. This is not a good sign. And then what they do is they'll go out and try to buy up all the local stock to stimulate their economy, and it's no different than when you look at the stats here that I've shown on how idiocy it is to me, how you allow household debt to be part and measured as domestic GDP. To me, that should be taken out, and I think it's just another way of trying to make themselves look good, and the politicians love that, and just basically spin it and say, "Hey, look, we're doing great," and a lot of it is driven by household debt. This is absolute lunacy. So again, we continue along into more breakdown. So here, what we have here is a euro area yield curve. Euro area shows separate AAA euro area central government bonds and all euro area central government bonds, including AAA. So we know, and we've always known, that the ECB has always, that Germany has pretty well bankrolled all of Europe. Now, for my consumption here with the Bloomberg things, the big pop for me was how Germany is now going back into negative territory on their bank rates, or that seems to be what I understand here. But guess what? This is the yield curve, which is not as wide as it should be. But here, this is insane. You go out, you buy a 30-year bond, and what are you going to get? This is crazy. 1.266 as a safe bet to get yield after 30 years holding this 30-year bond. And all they pay out is a whopping 1.266 on this forward curve. That is atrocious. That is, like, again, warning signs upon warning signs. Here, if you take out, let's say, a 5-year, they're going to pay you, get this, you buy a euro rated bond, AAA. Okay, so it says here solid lines, AAA rated bonds only. So here on this solid line, 5 years, it's going to pay out a whopping negative. Let me repeat, negative 2.3 or 0.234%. That is like you're paying them to hold their bonds, and they're going to give you basically less than what you give them at the beginning after 5 years. That is what we call deflationary. That is what we call 1929 29 economic conditions that lead into what else? The global depression that we experienced, and I went over that a few videos ago. And I don't think this is going to change over the next while. And how do I know that? Because here, if you pay a 10-year bond, a AAA rated again, after 10 years, they'll give you a whopping 0.464%. So make 0.5% on that capital you give the ECB to sit on that for 10 years. That is crazy. Okay. So here we are again. Oh, and again, all this chart is for November 30th, 2017, yesterday. Okay. That's what they're paying out. That is danger. So here we have the 3-year bond. Investors lap up tepid inflation data. Tepid because, well, it's negative. Push Portuguese yield to new low. Okay. So that was 3-minute read. When's the date? November 30th. So a day ago. Okay. So what we got here in the highlights, Eurozone inflation at 1.5%. Okay, I just put up a chart on how in Argentina, where they think that's probably one of the better places to put capital, they just issued was it a 50 or 100-year bond, and it paid like nothing, like 2%. So again, you put out a dollar and you let it sit there for 50 years or 100 years, and you're lucky to get 2-point-something% back after 50 years. That's how desperate the global economy is right now for yield. Bond yield broadly lower, led by periphery. Periphery being the southern um, countries in Europe, Greece specifically. That would include Portugal, uh, Portugal, Spain, somewhat Italy. So Eurozone periphery, government bond yield, blah blah blah. Man, Portugal bond yield hit their lowest level in more than 2.5 years on Thursday. So there was good times for 2.5 years, and it's going back to where it was. Yay! Um, is weaker than expected inflation data from the bloc suggests the ECB will remove its massive stimulus gradually, and they're racking up a debt. Uh, I don't know. I'm not liking the looks. 19 country currency rose to 1.5%. Boy, and Germany's carrying all that. Who had braced for strong numbers after firmer than expected inflation numbers from Germany. Um, yeah, fell 7 basis points to 1.87, lowest since early 2015, well before the Trump bump came along in the global markets. I could go on. Anyways, not looking pretty, folks. Yeah, the other one I wanted to highlight was Italy 10-year spread with Germany narrowed to as much as 138 basis points, tightest in 3 weeks. Germany 10-year bond, oh boy, 10-year bond fell 2 basis points to 0.37%. So they're close. They're close to hitting zero. And remember, folks, where it really will hit and hit hard for a lot of people is when the U.S. Treasury 10-year hits that zero and goes negative. I predict that will be the cataclysmic downfall for everything that what Europe's kind of facing right now. Followed rise of 5 basis points on Wednesday, biggest one-day jump in Bund yield in 3 weeks after backdrop stronger than expected Germany inflation. So it's Germany that's kind of bankrolling it all, but when they weaken, the rest of the countries go down in Europe. Anyways, I just want to put that out there and let me know what you think, and we'll talk to you later. Bye.